Asset allocation and diversification. Do they still work? In March and April 2020, the COVID-19 pandemic and its ancillary detriments on the global economy brought the 10-year bull market to a crashing halt. Since that time, the markets have largely recovered but have been plagued with extreme volatility, leaving individual investors frightened and confused. While every investor knows that risk comes with the territory, the recent wild gyrations are enough to make even the hardiest investors feel unsure. Let's find out whether the fundamental principles of asset allocation and diversification remain the best ways to control risk. Watch now. Welcome back, folks, to another edition of Sweetie Kiwi. How you doing today? I hope you are doing fantastic. I'm doing marvelous if you were to ask me. If you are doing as impeccable as I am, go grab a cup of coffee or tea or vodka. Let's roll. Today I want to talk to you about the fundamental principles of asset allocation and diversification, and let's just see whether they still hold true. Now, let me first say before I even start here that I'm not giving any kind of financial advice or investment advice. We're not professionals. We do have knowledge on investments, and our team has conducted research, and we're sharing with you the results of that research. For your particular situation, please consult with someone, an expert who has better information and who can guide you based on your particular goals. Having said that, let's just dig right into it. Asset allocation and diversification those two constitute the best investment strategy. They still do. Asset allocation and diversification seem pretty familiar to a lot of people, and they seem pretty similar, and a lot of folks confuse the two, but they're actually quite different. A key to creating a sound investment portfolio is to understand that difference and how the two work together. What is asset allocation? Asset allocation is the way you divide your money among major investment categories like stocks, bonds, cash, and other types of investments, some of which are riskier than others. Therefore, this separation, this distinction, this segregation into the various asset classes should be based on how much risk you're comfortable taking and how soon you'll need the money. There are two things here, folks. You have how much risk, what is your risk tolerance? That's the key word here, risk tolerance, and liquidity needs. So how much risk you're comfortable taking and how soon you'll need the money. Those are the two elements that should guide your asset allocation strategies. While stocks traditionally have the highest return potential, they also carry the highest short-term risk. Cash, on the other hand, have the lowest return potential but the least amount of short-term risk. And experts say that typically, bonds are somewhere in between on the risk spectrum. So any money you will need within the next 3 to 5 years should be kept in lower risk investments. Now, asset allocation is very important for all kinds of investors, whether we're talking about retail investors or institutional investors. It was first introduced as a matter of tactic as a way to manage risk in the 50s. So research showed that a portfolio's overall risk and expected return was a result of how each underlying investment performed individually, as well as how investments behave together. So if you're able to diversify, if you're able to choose different asset classes, you are able to reduce overall risk. Now, when I'm talking about asset allocation, there are several ways here. You have stocks, bonds, cash. What are the other types of investments I was referring to earlier? You have to think about ETFs, exchange traded funds, mutual funds, bond funds. You can even, depending upon, again, your risk tolerance, depending on your risk mitigation plans, you can you can welcome alternative investment into your portfolio. I'm talking here about real estate. I'm talking about valuables, collectibles, commodities, and so on and so forth. So the more sophisticated you are, the more diverse you can create a portfolio. It all depends upon your goal. Let's now talk about diversification. So I explained to you what asset allocation is. Now let's talk about diversification. Diversification takes the concept of asset allocation a step further. So you are basically here, you're sitting here and you're making a change based on what? Based on the situation, not only in your personal life, but also on the market. So diversification takes the concept of asset allocation a step further by spreading your money between different types of investments within each class. For instance, instead of one stock or bond, ideally you would have many. Dividing even further, you should have different types of stocks such as large cap, small cap, and international. And within those divisions, you can diversify further by investing in different sectors. I'm talking here at telco, healthcare, technology, consumer staples, and different industries within the sectors. In the case of bonds, you can diversify within government agency, corporate, international, and high yield. High yield is the same thing as junk bonds, and you can do that across different maturities. Your main goal at the end of the day here is to find investments that don't move lockstep with one another. In other words, you want to have investments that have a low correlation among themselves. That way, when one investment goes through a rough patch, another will hopefully compensate. And that's the kind of balance you want to strike as you are constituting a great portfolio. You might say that asset allocation lays the foundation for your portfolio, and diversification builds the floors and rooms. So if you're able to mesh the two together perfectly, you have greater opportunity for your investments to perform differently under various market conditions. One investment might go up when the other goes down and balance your risk, but in the long run, they will both come up pretty well. And this is the kind of stuff you want to have in your portfolio, the kind of strategies. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're also having a conversation today around asset allocation and the diversification. Let's talk about adapting to changing market realities. It is very important to understand that asset allocation and diversification as portfolio tactics have to be adapted to the market realities you're currently going through. So what if anything happens? What if something happens to your portfolio? What if markets are changing? As first became apparent during the Great Recession of 2008, globalization has made markets more susceptible to external shocks, and this caused increased volatility and stronger correlations between asset classes. What I'm trying to say is that we are now in a globalized market. So if you have a portfolio manager in Shanghai and another one in Chicago or one in London, they're all using the same tools. They're all betting on the same markets. They're all buying and selling on the same markets. And what happens is that this greater integration of tools, people, and markets has increased the correlation between asset classes. It has also increased volatility, by the way. So this is why investors were surprised, because they had expected different asset classes they held to zig while others zagged, and instead they experienced that as asset classes zig, the others will zig too, or zag by a much smaller amount. In other words, those assets were moving in lockstep. This doesn't mean, however, that diversification and asset allocation did not work. They just did not provide the level of protection that one would have hoped for. So in 2008, if anything, this experience shows us that we need asset allocation and diversification more than ever. Market volatility only reinforces their importance. And this is why a lot of investors are now paying attention to several factors in their portfolio. And you, as a retail investor, you have to go back again to what I like to call the two key things, the two key aspects of your portfolio management: your risk tolerance and your financial goals. Your risk tolerance should match pretty well with your financial goals. If it doesn't, then you are just you might screw yourself over, and it's not just yourself, it's your family, and those have consequences. The negative portfolio in your the negative negative performance of your portfolio can have an impact on your family's financial situation, but also in your descendants, in your heirs financial portfolio, financial situation rather. Why? Through the estate planning scheme, because your assets ultimately will have to be folded into your estate plan, whether through a living trust, whether through a will, whether through other probate avoidance schemes. One thing I want to talk about when it comes to adapting to changing market reality is that we have now low-cost, non-traditional asset classes you can use to diversify more, to improve your asset allocation strategies. And the relatively new availability of low-cost, non-traditional asset classes can help. Investments like real estate, I'm talking here about real estate investment trust or REITs, also known as REITs, commodities, I'm talking energy, agriculture, precious metals, treasury inflation protected securities, the TIPS, and international bonds have historically had low correlation to traditional asset classes. In other words, they move differently in different markets. So if you add small amounts of those securities to your portfolio, you can increase your diversification, potentially lowering your investment risk over time. Let me again list those 3 or 4 asset categories that you might want to consider adding to your portfolio. So REITs, real estate investments trust. You have commodities. I'm talking here energy, agriculture, precious metals. TIPS, treasury inflated protected securities, as well as international bonds. Now, when it comes to international bonds, please make sure that you're choosing bonds from countries that are solid. I'm talking here Germany, for example, France, the UK. Those I'm talking here about sovereign bonds. But if you want to go with corporate bonds, please choose the bonds issued by solid companies, quote unquote solid companies. So you have to pick big countries, large countries: Canada, Germany, France, UK, China, Japan, and within those countries, you pick the top companies. So you're basically are covering here the liquidity risk. You're covering also the interest rate and the default risk, because you want to make sure you get paid, right? And you want to make sure the company doesn't go belly up. So you want to make sure the company is still around. So if you want to go with international bond, please go with those AAA sovereign bonds or corporate bonds. The thing is that the exact amount of bonds or commodities or real estate or REITs or TIPS that you buy depends on your situation and investment preferences. Again, if you if you don't have a knack for things investing or things portfolio management or things that relate to risk management, reach out to an expert. Diversification cannot always protect you against short-term market declines, but historically, it has been a great defense against long periods of poor returns, which can be more destructive. It remains a great strategy. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're also having a conversation here around asset allocation and diversification. If you love the content's clarity and quality so far, please consider subscribing to our channel and turn on the notification bell so you can be informed in real time whenever we drop a new show. And we drop this kind of shows every single day, rain or shine. Rain or shine. How do you stay on top of it all? You gotta stay on top of it all, right? I mean, you can't stop there. Once you've built your well-diversified portfolio, it's also essential to stay involved. I'm talking here about doing research, keeping tabs on things, monitoring your portfolio, having a conversation with your financial planner, and just, we're talking here about your financial situation. We're talking about your retirement. So those are important goals. Those are important metrics. Those are important elements in your life. So you want to have a conversation with the right people in your entourage, and also trying to stay on top of it all. In general, it's smart to review your portfolio and rebalance at least yearly to stay within your target mix of investments based on your risk tolerance and time horizon. However, in times of extreme volatility, experts recommend that you do this more frequently, perhaps quarterly, and alternatively, you can rebalance when your investments fall outside of 5% of your target allocation. Target allocation means like you are specifying percentage points for each asset category. So you can say my target allocation is 50, 35, and 15. So 50% stocks, 30% bonds, and 15% cash and cash equivalents. And while it's never a good idea to try to time the market, it can make sense for some investors to make small changes to their portfolio to attempt to either take advantage of market opportunities or minimize losses. This is pretty good for folks who are in their 50s who cannot wait for they want to minimize losses, for instance, or folks who are in the 20s and they want to take advantage of market opportunities. This doesn't mean, though, that you would move in and out of the market altogether, but rather rebalance and make small shifts to respond to changing market conditions. Now, folks, there is a lot to think about. There's a lot to say when it comes to asset allocation and diversification. But the bottom line is that those two elements, asset allocation and diversification, they remain essential tools. They are quintessential tools for protecting your portfolio. The more broadly you diversify, perhaps with the addition of new types of investments, the more you can potentially reduce risk. Now, if you need more help, you want to always talk to a financial advisor and you want to discuss changes before you make any moves. I will see you another time. But until then, remember, stay marvelous.